Okay, I want to move on to you got a couple of great papers on financial advice. In your audit study on financial advisors, how well did they de-bias their prospective clients?
So we did an audit study of financial advisors in the US, where we sent, in a way, mock clients, if you want, to different financial advisors, and these different clients had different portfolios that present different biases. So, for example, some of them were return chasing, some of them were under diversified and held too much of their company stock, meaning, the company where they're working, which is not good for having a well-diversified portfolio allocation. What we saw is that financial advisors de-bias their clients when the decisions that people then would make benefit the advisors
Mm,
financially. So, for example, right, if a client holds most of the money in their own company stock, that is bad for the client, for sure. But it's actually also something where the advisor, by helping the client, makes money, right? Because the
mm,
advisor can tell the client, move away from that
yep.
one stock,
Yep.
diversify and buy a mutual fund where they then benefit, right, from, kind of the compensation. Unfortunately, we saw that when clients have biases where the advice would go against the financial advisor's incentive, then they do not de-bias. And
Wow.
do I mean with this is, right, like, say there are some clients who think, you should be chasing different different industry returns or different subsets of uh, the fund strategies, right? Those clients are, of course, in some sense, useful clients to financial advisors, because you can rebalance their portfolio all the way and push it from one type of fund to another, and each time basically get fees as an advisor. And there, unfortunately, we saw that advisors didn't give people, say, the advice to just invest in low-fee index funds, because that's not so much in their own in personal interest, right?
Hmm. So that suggests conflict of interest affecting the advice.
Absolutely, yeah. You're saying it very eloquently, right? All the stuff I just said, right? Basically, yes, it means that it affects the advice. But I do want to say, because I don't want to be to in a way to be bludgeoning advisors either. I mean, it is true that in situations where the advice is, in a way, doesn't lead to a conflict of interest, they did give good advice, right? And in a way, I would say that one of the problems actually is that we have, maybe in the US in particular, too many financial advisors, that actually are brokers and not
Mm,
fiduciary advisors. And,
mm,
in the US at least, there's a difference that if you're a broker, you don't have a fiduciary responsibility to your clients, right? You just need to not defraud them, basically. It's a very minimal responsibility. While registered investment advisors, who are fiduciaries, they actually need to make sure that they put you into the lowest fee funds and act in your interest. But
indeed.
unfortunately, in the US, less than 10% of professionals who act as advisors are actually registered as fiduciary advisors.
Hmm. Yeah. So in that audit study, how did the advice of the advisors line up with portfolio theory?
So I would say, on a minimal basis, it wasn't too bad. Now, this sounds somewhat circumspect, right? But what I'm trying to say is that the majority of advisors actually did advise people to put money into mutual funds. And therefore, right, at least there was a minimal set of diversification
Hmm.
of the portfolio that these advisors actually recommended. And so I would say, they didn't give terrible advice, right? Where the problem came is more really that they were not necessarily always putting people into the type of mutual funds that have the lowest fees.
Mm.
And they are erring on the side of putting people into actively managed funds. And we know that actively managed funds often have very high fees without doing better than an index fund. And so this is the margin where I feel retail investors should be very vigilant, if you want, and they should understand that typically a low fee index fund is really the best allocation that they can do for themselves.
How do investors' prior beliefs affect their receptiveness to receiving financial advice?
That's a very good question. I would say from some of the work that we have done is that this is actually a relatively subtle answer, and the question is subtle in the following sense. You very often hear from financial advisors in the market that somehow you have to cater to people's belief. You have to basically just tell them what you want, what they want to hear.
They want to hear.
And you cannot educate people, which it's a little bit condescending, but it's also very self-serving, right? Because it basically means if I give somebody somewhat suboptimal advice, it's not my fault, it's because the client couldn't understand better. So from my research, at least, that doesn't fully line up with what we are finding, because what we are finding is that when people have more financial literacy, right, when they know already some finance, they actually want to get advice that is more aligned with textbook advice, meaning, they actually expect advisors to tell the clients that they need to be well diversified, minimize fees, not go into active funds, right? And so actually in those situations where the clients has this strong priors, it's when they are more sophisticated and when they're expecting better advice. However, what we find is that the type of client who has very little financial literacy, they actually are very malleable. So it's not the case that you need to cater to them much, because actually whatever the advisor tells them, the client is typically willing to believe. Now, for the client, that's not so good, because it means if they're getting bad advice, right, they are just moving into that advice as happily, if you want, or as easily as moving to the good advice. But actually, remember the argument we started with is that you have to give the client what they want to hear. And there the argument is no, because the client doesn't know what they want to hear. They don't have much of a prior. So they're very willing to accept good advice too, right? And so there's in a way no excuse to give these clients very biased or distorted advice. They weren't waiting for distorted advice, right? I do want to say one thing which is probably true, and that I've heard from many advisors, and even I see this in my own students, right? It is true that when the market becomes very hot, or when there is basically, certain asset classes are very bubbly, as people like to say, right? But basically when there has been a run, it is true that then there is a lot of temptation for people to, in a way, follow those trends. And I think probably it is true that a good advisor who understands their clients well does need to put a lot of effort to explain to people that now, look, these are exactly the times where being diversified and not breaking your portfolio allocation, it feels like, oh my God, I'm missing out because crypto is going through the roof, right? But if you go then into crypto, it will crash on you, right? So, kind of, and then hindsight is unfortunately very painful. And so I'm just saying that I'm not trying to say that it is easy for financial advisors to explain to people what good advice is and why you have to have discipline in your portfolio. So I'm not belittling this. All I'm saying is that it's not the case. that somehow, especially financially uneducated customers have crazy beliefs and cannot be persuaded of more rational financial strategies.
So people with high financial literacy have a prior that high fees are bad, index funds are good, and then people with low financial literacy don't really have any priors and are receptive to advice. How does receiving advice change the priors of each group? Like if you take a financially literate investor who believes in index funds and put them in front of an advisor that says, no, actively managed funds are good, how does that affect their beliefs? And then likewise for people with low financial literacy.
Yeah. So what we found is that for the people that have high financial literacy and you tell them, the opposite, they actually dislike the advice. And they basically downdate on the advice and they don't change their beliefs very much. Now, for the people with low financial literacy, we basically see that, yes, they react to the advice that's given and they move their priors in the direction of the advice, whether it's, good advice or bad advice.
Yeah, it's really interesting. And then how does advice, so you did this experiment where people receive advice, and then I think there was an activity where they had to actually choose to invest their own money and there was a prize or something, like a contest. How does the advice that they received affect how they actually invest their money?
Yeah, so we do see that the advice that they receive affects how they invest their money. And what I mean with this is that, again, we see that financially more literate people are more likely to pick index funds and low fee funds, and financially less literate people are more likely to also pick active funds and higher fee funds. We do find then, however, that the advice, people follow or change their investment behavior in response to the advice. And we think, kind of that part of the, even though people, even very educated, financially educated people, might on paper understand that you need to be diversified, that you need to pick index funds, that you need to pick low fee funds. But when given actual funds to pick, they don't necessarily what that means, right? Mm-hmm. There's a big difference between knowing that you should be well diversified and knowing, kind of how to build a truly diversified portfolio, right? Is it 10 stocks? Is it 50, right? How much do you allocate to each, kind of basically stock in the market portfolio, right? This is obviously, in a way, more difficult than just knowing the concepts. And so I think this also highlights, in a way, right, that financial education, goes a long way in helping clients and average people know what to ask for from an advisor, but they still need to rely on the expertise of the financial service industry in really implementing those strategies.
Yeah, that's a big insight. So people can get the general concepts, and that puts them in a much better position to receive advice, but it doesn't necessarily imply that they can just go and do it themselves successfully.
Exactly. I mean, in a way, and why would we expect, right? We don't expect people to do, kind of appendicitis on themselves, right? I mean, we want doctors who can tell you what the right diagnosis is and then do it for you, right? And in a way, financial services is very similar to any type of expert service.
But it does highlight how important financial literacy is for someone to be able to detect when they're getting bad or conflicted advice.
Exactly, right? Because, I think to me, this is a very important, dimension that also regulation needs to be aware of, right? Is that the market for financial advice, of course, is meant to be a private solution in a world where, yeah, financial decisions are complex, but choosing a good advisor needs already literacy, right? And how to pick a good advisor is in a way one of the biggest decisions that actually retail investors make. And I think, in the US at least, it's often very much left to retail investors without much help. Again, because as we were discussing before, most professionals who give advice have very minimal fiduciary responsibility to their clients.
Yeah.
How does advisor compensation affect how their advice is perceived by the consumer?
Yeah. So what we find in our research, so in the US, there are different models of how advisors are compensated. A majority of advisors is basically compensated by fees that they're getting from the mutual fund providers to whom they allocate clients' assets, and that creates a conflict of interest, of course. Now, there are also models, for example, where advisors are paid just by time spent with the client. And then what you also find is, especially for much wealthier clients, that advisors are paid by assets under management. And there, the incentives are obviously much more aligned. The issue is often that, in the market for financial advice, there are lots of financial service companies that are marketing their services as saying that the financial advice is free, but it's not free, right? Because it is paid. The advisors are paid by back-end fees that those mutual fund providers are providing to to the advice company. And the problem is then the following. What we see in our experiment is that when customers are being told that the advisor has a compensation scheme that conflicts with their interest, they're actually reacting less to the advice. So in a way, that's very rational, right? They basically realize there could be a conflict, so I should take everything with a bit of a grain of salt. And if the advisor is very well aligned with the client, they're much more willing to believe it. So that's, again, it's great in this experimental setup. What I'm a bit worried about is that in the real world, right, where you have a lot of advisors who will market their service as if they were for free, many consumers might not understand that, in a way, you have to pay for advice. And therefore, an advisor that says, look, I do need to be paid, say, for the time I spent with you and for my human capital, right, and the effort I put, then it suddenly might seem to an uninformed retail investor, wait, this guy is willing to give it to me for free and has also a lot of beautiful slides and talk and blah.
That's right.
And this person says, I have to be paid. And then it sounds almost like this person is taking advantage of me, even though no, this is just the honest advisor who tells you how they are being paid. And so this leads to potentially leads to some adverse effects of competition in this market when customers are not informed, or fully understand how actually different advisors are being compensated.
Yeah, well, that's important. So consumers, given the information about how the advisor is being compensated, they'll make rational decisions in how they interpret the information, but that disclosure is not always obvious.
Exactly, right? And I think one thing that people, I know it sounds so boring and it sounds like a boring economist, right? But when you are shopping for any type of financial advice, but also maybe other advice, you have to expect that the person has to be paid, right? Most people don't work for pro bono and for, I don't know, the kindness of their heart. And I know that's what I'm saying. It sounds like the horrible economist who always, says that everything has to be compensated, but we all want to live and probably want to live well. And so why would advisors who have good knowledge, why should they give it for free, right? And so I'm just saying that, therefore, customers should always think the service has to be somehow compensated. If somebody tells me it's for free, that just cannot be true. So I need to dig deeper and understand, where are they getting paid, right?
Yep. Gotta follow the money.
Indeed.
So based on the research that you've done on financial advisors, what do you think consumers should be looking for when they seek out financial advice?
Yeah. I would say, number one, as we just discussed, they should really understand, how is the advisor compensated, right? What is the alignment of incentive or the conflict? And typically, it's actually great if your advisor is paid by asset under management, because then, when your portfolio does well, they do better, right? And the more they grow your portfolio, they also get more fees, but in proportion with the gains that the portfolio makes. In addition, I would say people should think about getting financial advisors whose fiduciary responsibilities are aligned with them. And of course, in different countries, I'm sorry, I don't know in Canada what the regulatory landscape is, but in different countries that means different things. But there are consumer advocacy groups, and kind of in the US, for example, there's also Consumer Financial Protection Bureau, and others, where you can get good information about what are the type of compensation schemes that are available, and what are the types of, in a way, supervisory frameworks for financial advisors. Yeah.
It is similar in Canada.
Is it similar in Canada?
Yeah. So over different words and different regulations, but overall a very similar setup, where there are brokers who are not required to act in the best interest of consumers, and then there are specific registration categories where they are required to be fiduciaries.